Hi guys, welcome to week 8. As always, lots to discuss, so let's just get on with it. So this week, I don't think anybody wants to hear about economic data. It's really kind of pointless when we're going to focus more on the geopolitics. Obviously, headline news is the Russia invasion into Ukraine, and obviously the impacts that has on global markets. So during this week, we've seen it all this week. Russia actually invaded early on in the week, Monday, Tuesday. There was already outbreaks into eastern Ukraine. However, markets kept reacting quite positively. There was upward movement on markets throughout the early part of the week. Things didn't really change until early hours of Thursday, when there was a serious advancement of Russian troops into Ukraine, and of course we started seeing major selling off, getting towards 3.5–4% throughout Europe. US markets suffered. However, that said, there was a huge reversal later on into Thursday trading. The reversals were quite extreme. The Nasdaq in particular went 7% from peak to trough, and that carried on into Europe. The momentum really picked up very quickly. How you can explain that momentum is really anybody's guess at this point. The upward momentum on reversal on the back of Thursday carried into Friday trading. By Friday, we were back at highs and index levels were already above where they'd been before any war even broke out. That's a huge surprise when really nothing had changed, and in fact we were then getting missile strikes on a major European city.
So what are the economic sanctions about? What about SWIFT?
So yeah, everybody's heard the news this week about sanctions. There is a degree of sanctions in place. The consensus is, and it partly is on the back of markets staying as buoyant as they have, is that the sanctions haven't gone as far as a lot of people believe they should. Everybody will have heard a lot of talk this week about SWIFT transactions being the next kind of sanctions that's imposed. So we'll kind of try and cover what exactly SWIFT is. SWIFT is nothing other than a global financial messaging service. You're looking at a transaction rate of about 40 million transactions a day, but that covers trillions of dollars in both currency conversions and trades. Not everybody's on board with sanctioning Russia in terms of SWIFT. The UK is on board with it. Over the course of the weekend, more countries are coming to terms with the idea of that. However, you have to understand there is a broader impact on global economies. The main things are, it does hinder Europe's ability to capacity to pay for oil and gas. And if you're looking at the real impact of that, in the very first 24 hours that Russia kind of acknowledged the separatists in Ukraine, so if you just take that 24-hour period, you're looking at $700 million of commodities that were purchased through SWIFT during that period. The European approach has been a little bit different to the Americans at this point. So far, the US has cut access for Russian banks, but that's still a very lightweight approach. There are a lot of loopholes through that banking system, especially when it comes to energy.
So what has been the effect of all of this on equity markets?
I think at this point very little is making sense. Like we said, Russia began its invasion really Monday, Tuesday, but equity markets continue to rise. And even what you should have been looking at is your your oil and gas advancing. There was actually a period midweek where oil and gas had even pulled back. And that really makes no sense whatsoever at this point. And that's how there's still an imbalance in pricing. Thursday you saw the huge falls, which again, as we've discussed, were regained later in the trading session and into Thursday futures and into Friday. Friday saw huge positivity. Europe was up pretty much 4% across the board through Friday trading. The UK had its best day close-to-close price since 2008, and the US was also bouncing. And again, it comes back to, it just doesn't quite make sense when you've got missile strikes on a major European city. I think the biggest surprise out of that, a lot of it will have been algorithmic trading at the bottom, signaling buys, and off it goes. But it really comes down to investors to make responsible choices at some point. Friday buying, I personally believe it was reckless. But there's a point at which you think investors should really be taking profit through the later sessions on Friday. That we never saw any signs of that. And that is leaving investors completely exposed to what happens over the course of a weekend in relation to Russia and Ukraine. Now, during that weekend, we've had further Russian strikes on oil and gas within Ukraine, and Germany in particular stepping forward now with cries for sanctions on the SWIFT payment system. So you could be in, as of right now, kind of mid-Sunday, futures are looking down across the board. They have been as much as kind of 1.6, 1.7% down, currently around about 1% down. And that's the confusion bit, that investors were happy to just leave themselves exposed to that over the course of a weekend. Friday really was the point, the last 3 days of the week really were, you had spells on Thursday where it was a great opportunity to get out of short positions at profit. There were some buying opportunities. That went too much the other way. And really by Friday close, you should have been looking to, once again, pick up them short positions.
So this is a lot of negative right now. Do we need to review where people are positions right now?
So irrespective of the war, which is just another risk globally, and we've kind of touched on in previous weeks how investors start looking one way and avoiding all the issues that are on the other side. Them issues essentially don't go away. You still got the inflation issues, the issues of rates in the background, and investors are kind of blinded to put the whole thing together at the moment. You've still got the huge risks of companies to debt exposure. Really where you want to be right now, commodities are going to continue to be strong. A lot of people associate Russia, Ukraine with just the oil and gas, but Russia is also a huge country for a lot of your precious metals. A lot of the world's wheat comes from Russia, so you would see prices accelerating on most of your commodities. And of course this week, oil did go through the $100 barrel price. This has happened in the past where oil has gone above $100, and just don't expect that to retreat quickly anytime soon. There's a tendency for it to stay at them elevated levels for a long time. You'll have heard a lot of news this week. Defence spending is up, so obviously that's going to bolster your defence companies. Energy will remain strong, but I think regular listeners or regular observers of our Instagram will know how strong we've been on energy for quite some time. We're still incredibly strong on financials. Financials could get hit in the very short term as SWIFT sanctions keep in. But on longer term, understanding the macroeconomic stuff of rates and inflation, a lot of your lending banks and a lot of your financials will stay really strong. Places where you don't really want to be is your discretionary spending will still suffer, and even actually your staples will suffer. The staples that have exposure to commodity prices. And I know we still haven't touched on it fully despite some requests. Your home builders and your construction, these areas will really struggle as the pressure just continues to build in commodity prices. Margins can't be maintained, dwindling by the day, and it's just not a place you want to be right now.
So is there anything else we need to review this week?
So obviously it's never ideal looking at situations of global wars breaking out. The Russia-Ukraine situation is very relevant for now, and that's not about to go away in the next couple of days or so. But we have got people kind of asking, well, what happens if China kind of is looking to invade Taiwan at the same time? And this is something that has been lingering in the background as much as Russia-Ukraine has. There's no easy answer on this one. It will just be very negative all round. If China invades Taiwan, you're looking at the same type of sanctions that Russia have been looking at. But China has such a strong hand in terms of it could potentially cash the amount it is holding in US treasuries, and that is a vast amount of money. If it cashed its US treasuries, you'd be looking at the entire United States financial system, and therefore the knock-on effects on the global financial system completely crippled. It would put an incredible amount of pressure on the dollar, and the dollar is looking weaker and weaker as time progresses. It would cause huge supply chain issues on top of the supply chain issues that already exist. Taiwan is the leading supplier to the semiconductor industry. That would then put huge impacts on tech. And actually it's this scenario that is probably the biggest risk to a company like Apple at present. There is a theory that it could benefit European and US markets with capital flows diverted away from China into US and European markets. Personally, I'm not sure how much credibility that situation holds, as Chinese equities are currently very suppressed at the moment anyway. So any capital flight away from them equities, if you're looking at the likes of Alibaba, which is at a real low, despite being a great profitable company, there's not about to be a great deal of capital flow away from companies like that just to go to elsewhere in the world. These companies are already beaten down a great deal. And obviously that's been on the back of imposed Chinese regulatory issues over the last few months. So as we move on to this week's equities kind of review and looking forward as always, there's been some notable losers this week. In particular, Foot Locker, Zscaler and Beyond Meat. I think we should probably touch on them to begin with.
Foot Locker is a business under real stress. Revenue stalling all the way to 2024, negative year-on-year growth, forecast at -1%, net income slipping by half, and EPS to 5.5 from 9.9 in 2022. Scalar, we like. Asset price declines are actually unjustified, especially with profitability for the first time in 2022 at 90 million. Beyond Meat asset price soared on hype, but there's many risks to this business model. especially surrounding sustainability, and asset price will basically suffer more.
And of course, where we have the losers, there's always gainers. This week, some of the biggest gainers included car auction services and Block formerly Square. Where do we see them companies going from here?
Car sold its Odessa business to Carvana in a 2.2 billion deal, and price jumps are actually justified. But there's actually no more room in it. Block, formerly Square, saw a huge jump on Thursday, Friday. Balance sheet partly justified it, but it's best to sit back and watch. You've got increased competition that is actually a real concern.
I'd like to touch on a couple of 52-week highs and lows. Amongst your 52-week lows, we have Dell Technologies and Franklin Templeton. And also on the opposite side of that, we have the 52-week highs, including Chevron, Coca-Cola, Northrop, and also Nucor.
Chevron move is understandable, and they have forward earnings based on oil at $75 a barrel, which means price will go higher. The other three we've mentioned in previous weeks, Northrop was the charity trade we came out on Friday, but we would have happily held it. We highlighted Nucor, this will push further, and Coca-Cola has pricing power, which we've discussed in previous episodes. Dell is interesting. Off the lows, 2022, 2023, 2024 revenues are steady, but net income margin jump. Net income at 5.5 billion in 2024, and the stock is basically looking attractive.
So we can finish up this week with the requests that came through. And as always, we try and touch on as many as we can in a reasonable time. Selected them at random again. Hopefully some of the most interesting ones. So we're looking at this week Palantir, DraftKings and Tattoo Chef.
DraftKings saw huge high during height of the pandemic. Certainly value trapped a year ago at $70, but here we are just above $20. This stock is 90% institutionally held, so we're looking at the bottom right now. That said, the bottom will be prolonged. Even full year 2023 losses will still be more than 1 billion with EPS at minus 2.14. It's not only a speculative play, but you're looking to buy only if you're prepared to hold on the 3 to 5 years on horizon. We've always liked Palantir. We've held at higher prices than today, so we're happy to hold. Obviously, ARC coming out at huge losses, offloading 12 million shares, didn't help, but their balance sheet starts pointing towards a bargain right now at 11.5 a share. 2022 revenues up 30% year on year, and same again full year 2023. That puts net income at 670 million and current market cap at 23 billion. That means the upside, that's actually upside of 120% over the next 2 years. Tattoo Chef has the same issues risk we've mentioned with Beyond Meat, sustainability concerns and rising input costs. Price is down 60%, 50% actually, in 6 months. and that isn't just based on broader market. They know that, which is a plus, but profitability seems a long way off. If ever, 2022 full year revenue at only 280 million isn't showing growth year on year would hope for. EPS comfortably negative at minus 0.3. It's not a sector we like, and upside is really difficult to put numbers on. It would be tough to advise any position on this one.
Well, thanks guys for watching. That's everything for this week. Looking at the week ahead, let's just accept it's going to be a really tricky one. It's a week where investors really need to keep their head. We keep trying to stress patience is key. The nature of a war in itself and the impacts on markets, a lot of it can't be forecasted. A lot of it you just have to bide your time and see how it plays out. The markets will be there in a week's time, 2 weeks' time, a month's time. But really, you can only damage yourself at this situation by jumping in, and the upside benefits are very limited as things can turn around so quickly. So I think the main message from this week is it's just patience. Patience is key. Let things play out. Take your chances when they arrive. But it's just an overall rationality is what is required to get investors through another week. Thank you.